Good morning friends, my name is Anup Nigam. I'm a technical analyst. In the previous video, we learned about how do we calculate the profit or loss of the long put option. Now in this video, we'll try to understand how do we calculate the profit or loss of the short put option. A put option is basically an instrument that gives the buyer the right to sell an underlying asset by a certain date for a certain price. For selling the option, the writer of the option charges a premium from the buyer. The profit or loss that the buyer makes on the option depends on the spot price of the underlying asset. So whatever is the buyer's profit is the seller's loss. So if upon expiration the spot price trades below the strike price, the buyer will make the profit whereas the seller will make the loss. Lower the spot price, more is the profit for the buyer, while more is the loss for the seller. But if at the time of expiry, the spot price exceeds the strike price, the buyer will let the option expire worthless. That means he will not exercise his option. And in that case, the seller will get to keep the full premium. Now let us say the trader sells a put option of a stock X of strike price 2250. So whenever we sell the put option, we are likely to buy it back. So we buy it at a future date at an unknown price. So when we sell the put option, it refers to as short put. Now if the spot price goes up, the seller will make the profit, whereas if the spot price remains below the strike price, the seller will make the loss. Now let us try to understand how do we calculate the put option profit. So if the trader sells a put option of strike price 2250 of stock X at a premium of 100, and if this premium comes down to 95, and if this stock X has a lot size of 1000, so his profit will be 5 into 1000, that is 5000. Now let us see the loss scenario. So if the trader sells a put option of strike price 2250 of stock X at a premium of 100, and if this premium goes to 105, and if this stock X has a lot size of 1000, so in this case his loss would be 5 into 1000, that is 5000. Now let us understand the third scenario. So if the trader sells a put option of strike price 2250 of stock X at a premium of 50, but if at the time of expiry the spot price trades above the strike price, and if this stock X has a lot size of 100, the buyer will let the option expire worthless. That means he will not exercise his option. And in this case, the seller's profit would be the option premium that the buyer paid to have it. Now let us try to understand this with the help of the graph. So if the trader sells put option of strike price 2250 of stock X at a premium of 100, and if the spot price remains below the strike price, the seller will make the loss, whereas if the spot price trades above the strike price, then the seller will make the profit. So guys, in this video we have tried to understand how do we calculate the profit or loss of the short put option. So if you think that this video is informative, then please like it, subscribe my channel and share this video with as many traders as you can. Thank you. Dhanyavad.